If your home is fully paid off and you live in one of 5 specific states, the equity you spent an entire lifetime carefully building is being quietly drained away from you right now through a mechanism written into county-level tax statutes that most homeowners have never read and most attorneys have never explained to them. It does not announce itself. There is no letter that says your equity is at risk. There is no warning that appears when you pay your property taxes on time. The mechanism operates in the background, activating only when circumstances shift, and by the time most homeowners discover it, the process is already well advanced and the options available to stop it have narrowed significantly. A unanimous Supreme Court ruling in 2023 closed the most aggressive pathway this mechanism used to operate through. But that ruling only addressed part of the problem. The remainder is still active today in every county across these 5 states, and in 2 of them the situation is deteriorating further rather than improving. The homeowners carrying the most exposure are not the ones who are financially struggling. They are the ones who did everything right. They worked for decades. They paid off the mortgage. They watched the home appreciate. And they assumed, reasonably, that the equity inside that home was theirs to keep. That assumption is not protected by federal law. It is only as secure as the county-level statutes governing property tax enforcement in the state where that home sits. In 4 of the 5 states we are going to walk through today, a single filing at a county or town office costing under $75 quietly neutralizes the worst of what this mechanism can do. We will identify exactly what that filing is before this ends. But first, you need to understand which states this applies to, how the mechanism operates in each one, and why the seniors who own the most equity are standing in front of the largest potential losses. Start with the case that finally forced this mechanism into national view. A 94-year-old widow named Geraldine Tyler owned a 1-bedroom condominium in Hennepin County, Minnesota. She fell behind on her property taxes. The total amount owed, including all accumulated penalties and interest, came to approximately $15,000. Hennepin County seized the condominium, sold it at auction for $40,000, kept every single dollar of the proceeds, and returned nothing to Geraldine Tyler. Not a check. Not the difference between what she owed and what the property sold for. The county absorbed $25,000 of equity she had spent decades accumulating and treated it as entirely legal under Minnesota law. For years, courts in Minnesota and several other states held that this was acceptable. The legal reasoning was that once a homeowner falls behind on taxes, the entire property is forfeited, not merely the unpaid amount. Under that reasoning, a home worth $400,000 with a $10,000 tax debt could be seized entirely, and the state could retain all $390,000 of equity with no obligation to return any portion of it. Geraldine Tyler challenged that reasoning all the way to the Supreme Court. In May of 2023, the court ruled unanimously in Tyler v. Hennepin County that the practice violates the Takings Clause of the Fifth Amendment. The Constitution prohibits the government from seizing private property without providing just compensation. Absorbing $25,000 of equity over a $15,000 tax debt is an uncompensated taking in plain terms. That ruling changed the legal landscape significantly, but the change it made is narrower than most people assume, and understanding exactly where it stopped is critical for any senior homeowner in these 5 states. The Supreme Court did not eliminate property tax sales. It did not prevent seizure of a home over unpaid taxes. It only ruled that the surplus, meaning the portion of the sale proceeds that exceeds the actual tax debt, must be returned to the former owner. The home can still be seized. The auction can still happen. The deed can still transfer. The only new requirement is that once everything is settled, the county sends a check for whatever remains above what was owed. And that is precisely where the next layer of equity loss begins. because the rules governing how that surplus is calculated, who gets notified, how long they have to claim it, and what gets deducted before they receive it vary significantly by state and by county. And in most cases, those rules heavily favor the county and the investor over the former homeowner. In Minnesota, the state amended its tax forfeiture statute in 2024 in response to Tyler. Surplus funds are now held in a state account, and the former owner has a defined window to submit a claim. But the claim form is not mailed to the former owner automatically. The county sends a notification to the address on file at the time of the forfeiture. For a senior who has moved to assisted living or for a family managing an estate in probate, that is frequently a defunct address. The notice arrives at an empty house or a forwarding address that is no longer active. The deadline runs out. The surplus remains with the state. That outcome is not accidental. It is the predictable result of a notification system that places the burden of awareness on the person least likely to be paying attention at the moment the notice arrives. The investors and attorneys who participate in tax sales know exactly when surpluses are generated and exactly how to monitor the claim windows. They have systems in place to track every tax sale in every county in the states where they operate. Senior homeowners and their families almost never do. The knowledge gap is structural, and it consistently benefits the same side of every transaction. A 2-minute phone call to the county auditor asking whether any surplus from a tax sale in the past 2 years is associated with a property you owned or an estate you are managing resolves this in Minnesota. But that call requires knowing it needs to be made, and the number of people who know that is vanishingly small compared to the number of people for whom the call would matter. Nebraska operated one of the most severe versions of this mechanism in the country before Tyler. The state ran a tax certificate sale system that allowed private investors to purchase a tax lien on a delinquent property, hold it for 3 years during which the homeowner could redeem the lien by repaying the debt plus interest at 14% annually, and then convert the certificate into a full property deed if redemption did not occur. The redemption math is punishing. A $3,000 tax debt accumulates to over $4,500 before the redemption window closes. In one documented case from the late 2010s, a Nebraska homeowner lost a property worth nearly $200,000 over a tax debt of less than $6,000. The investor received the full property value. The homeowner received nothing. Following Tyler, Nebraska now requires the investor to return the surplus to the former owner after redemption fails and the deed transfers. But Nebraska statute permits the county and the certificate holder to deduct what are called recoverable costs from that surplus before it reaches the former owner. Those costs include attorney fees, title search fees, recording fees, and the full statutory interest that accrued during the redemption period. In most Nebraska counties, those deductions total between $3,500 and $4,500 per case. A senior entitled to $20,000 in surplus equity may receive $16,000 or less after the deductions clear. For a senior living on a fixed income, $4,000 absorbed into procedural costs can represent the difference between remaining in their home with in-home care and moving to a state facility. Nebraska offers a homestead exemption for property owners over 65 with income below a defined threshold that reduces the assessed value of the home, or in qualifying county programs, defers the property tax bill entirely until the property is sold. The deferred amount becomes a lien but does not accumulate at the higher statutory interest rate charged on delinquent tax debts. A senior who qualifies and files for the deferral avoids the certificate sale process entirely because they never fall behind on taxes. The application goes to the county assessor, costs nothing in most counties, and can be completed in a single office visit. The program is deeply underused because neither adult children, tax preparers, nor county staff are required to inform eligible seniors it exists. The county assessor is aware of it, but has no legal obligation to volunteer that information to someone who walks in to pay a tax bill or ask about their assessment. Tax preparers focus on filed returns, not on county-level administrative programs that exist outside the tax filing system. And adult children of elderly homeowners are managing caregiving, finances, and family logistics without typically knowing that a property tax deferral program is one option among many. The result is that one of the most effective protective tools available in Nebraska sits unused by the overwhelming majority of people it was designed to serve. New Jersey presents the same underlying problem, but at a significantly larger scale. The state has the highest effective property tax rate in the nation. In counties including Bergen, Essex, and Union, the average senior homeowner with a paid-off residence pays between $12,000 and $18,000 per year in property taxes. For many retirees, that annual tax bill exceeds what they spend on health care. New Jersey operates a tax lien sale similar in structure to Nebraska's, but with an interest rate on delinquent liens that can reach 18% annually, plus a 6% penalty on the original balance. A $5,000 shortfall can grow to over $10,000 within 3 years under that accrual structure. New Jersey adds a further complication through its abandonment doctrine. A municipality can classify a property as abandoned if it sits vacant for 90 days, which compresses the redemption window from 2 years down to as few as 45 days. A senior who moves to assisted living while family members deliberate about selling the home can have the property classified as abandoned by a code enforcement officer before the family has made any decision. In a standard New Jersey tax foreclosure involving a paid-off senior home, the surplus owed to the former owner following Tyler can range between $20,000 and $50,000. But New Jersey statute permits the lien holder and municipality to deduct attorney fees from expedited proceedings, which routinely run between $3,000 and $4,000 per case, along with lien interest, the statutory penalty, and administrative charges. The $4,000 equity loss in New Jersey is not a worst-case scenario. It is a near-certain outcome in any foreclosure that reaches completion. The most effective defense available in New Jersey is the Senior Freeze Program, formerly the Property Tax Reimbursement Program, available to homeowners over 65 with household income below the annually adjusted cap. The Senior Freeze locks the property tax bill at the level from the first year of qualification, and the state reimburses the homeowner each year for any amount above that baseline. A senior whose tax bill rises from $12,000 to $15,000 over 5 years receives a $3,000 reimbursement check annually from the state. The program is free to apply for but must be filed every single year with the New Jersey Division of Taxation. Missing one filing year resets the baseline to the higher current amount, eliminating the accumulated protection permanently. There is also a structural cash flow problem. The municipality bills the full amount annually. The homeowner must pay it in full and wait for the state reimbursement check to arrive. A senior who cannot front that gap in cash continues accumulating delinquency while waiting for a check that arrives months later. Illinois had one of the most aggressive equity-stripping tax sale systems in the country before Tyler. Cook County was the center of the activity. Documented cases show Illinois homeowners losing properties worth between $150,000 and $400,000 over tax debts as small as $4,000. Following Tyler, Illinois revised its tax code to require surplus return, but homeowner advocacy organizations have characterized the revisions as structurally insufficient. The statute still permits the certificate holder to deduct collection costs, attorney fees, and accumulated statutory interest before the surplus reaches the former owner. In Cook County, those deductions average between $3,800 and $5,200 per post-Tyler case. A senior owed $30,000 in surplus may receive $25,000 or less after deductions. Illinois offers two protective filings that work in combination. The senior citizen's homestead exemption is available to homeowners over 65 occupying the property as a primary residence and reduces the equalized assessed value, generating annual tax savings that typically fall between $400 and $700. The Senior Citizens Real Estate Tax Deferral Program allows homeowners over 65 with income below the annual cap to defer property taxes entirely. The deferred balance becomes a lien at a low statutory simple interest rate and is settled at the time the property is sold or transferred. The senior never falls delinquent, never enters a tax sale, and never loses equity to surplus deductions. The deferral application costs nothing in most counties. It is chronically underused because most seniors believe incorrectly that deferred taxes create complications for their heirs. The actual outcome is the opposite. The deferred lien at a single-digit statutory rate is far more favorable than the double-digit interest that accrues on a delinquent tax debt, and the lien settles cleanly at sale without penalties. Massachusetts is the most urgent state on this list because the conflict over senior home equity there is still developing. The state has a property tax cap called Proposition 2-1-2 that limits annual tax increases to 2.5%, plus growth from new construction. But municipalities have been using a ballot override mechanism to exceed that cap with increasing frequency. When an override passes, a senior on a fixed income in that town can see their annual property tax bill rise by $1,000 to $4,000 with no ability to prevent it through individual action. Beyond the override mechanism, a more aggressive concept called the unrealized equity tax is being actively discussed in Massachusetts town meetings and legislative committees as of early 2026. No municipality has passed one yet, but the discussions are ongoing. An unrealized equity tax applies a surcharge to the appreciated value of a home above its original purchase price. A senior who bought a home for $150,000 that has appreciated to $700,000 would owe tax on $550,000 of appreciation at a 1% rate, generating a $5,500 annual cash obligation on equity they have not liquidated. Massachusetts offers the Senior Circuit Breaker Tax Credit, filed with the state income tax return at no cost and refundable for seniors with no tax liability, and the Clause 41 local exemption filed annually with the Town Board of Assessors at no cost. Together, these filings can offset between $2,500 and $4,400 of annual property tax. The single filing that neutralizes the core of this mechanism in 4 of the 5 states costs under $75 and can be completed at a county or town office. In Massachusetts, it is the Declaration of Homestead. In Illinois, it is the Senior Citizens Homestead Exemption. In Minnesota, it is the Homestead Classification. In Nebraska, it is the Homestead Exemption. New Jersey has no equivalent statutory protection of comparable scope. The Homestead Declaration designates the property as a primary residence and shields a defined portion of equity from creditors and forced sale proceedings. In Massachusetts, that protection extends into the hundreds of thousands of dollars. The filing is permanent for as long as ownership continues and commonly transfers automatically to a surviving spouse. Take these 5 specific steps this week. First, confirm whether you live in Minnesota, Nebraska, New Jersey, Illinois, or Massachusetts. If you do, your exposure is active right now. Second, file the Homestead Declaration in your county or town office. Third, request your current property tax assessment and compare it against recent comparable sales. If the assessed value exceeds market value, file a zero-cost abatement application. Fourth, ask your county assessor whether a senior tax deferral program is available to you. If it is, file the application. Fifth, schedule one consultation with a licensed elder law or real estate attorney. 1 hour of that attorney's time spent reviewing your homestead status, deferral eligibility, and any outstanding surplus claims from prior tax sales in your county commonly returns more than the consultation costs within the first year of corrected filings. Equity built over a lifetime does not disappear in a single dramatic event. It drains through missed notices, procedural fees, and filings that were never made. The defense is equally quiet, equally procedural, and equally available to anyone who knows it exists. What separates the senior homeowners who preserve their equity from the ones who lose it to this system is almost never financial sophistication or legal expertise. It is simply access to the right information at the right time. The filings described here are not complicated. They are not expensive. They are not limited to people with attorneys on retainer. They are available at county offices across all 5 states to any eligible homeowner who walks in and asks for them. The only barrier is knowing they exist. This has been Retirement Wealth Watch.